With both the US and China increasing tariffs on each other, is the S&P ready to roll over? We look at the midweek review for May 14, 2019. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on the examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, we review the S&P daily chart. Also, how has the weakest of the big three, the Dow, handled the possible trade war? How bad has tech taken the news? What can we interpret from the New York Stock Exchange advanced decline line? Is the new high-low line telling us that we are in trouble? We look back to 2016, the last time the S&P entered a stage 1 rally. How did the advanced decline line and the new high-low line look? And finally, what does this mean? The failure of a trade deal has not been taken well. On Thursday, there was a major sell-off, a pause on Friday, and a major sell-off on Monday. Tuesday, there was a bit of a reprieve, but overall the losses have been steep. But let's remember that the SP had hit a temporary peak before the China news, so a short-term pullback was possible. Now the key will be, can price hold at or above its 200-day moving average? As we see, the MACD momentum had turned negative around the highs of the S&P, and since then the bars have grown negative in intensity. What the S&P can hope for is a weakening of this negativity, at least so that price can begin to find a floor. Here we see the Dow. Last week I had mentioned that this index had already began to weaken before it reached its all-time high. And it has been the weaker of the big three, the others being the S&P and the Nasdaq. Now with the negative outcome of the trade deal, this index, though with similar losses, now is in a very precarious situation. Price has fallen about 6% from its peak, but more important, price is now hovering around its 200-day moving average. Now, will the 200-day moving average be the line in the sand, the line of support, before the Dow gets some strength and makes another leg higher? We shall be watching that. Like the S&P, we see the MACD show weakness before the trade deal news. At minimum, the rally got tired and just needed to pull back. That in of itself is normal in a market that is trying to get into a long-term bullish mode. But for now, negative momentum will need to lessen. Now, one of the biggest sectors hurt by the trade news was the tech sector, where the fear of less orders heading to China in retaliation or cost increasing of goods made there coming here, this sector has had a punch in the gut. From its peak in late April, the drop has been close to 10%, and now price has fallen below its 50-day moving average. So what to look for? We need a short-term bottom first. After that, in the short term, there may be volatility while the tech sector tries and regains strength. Will the 200-day line be the line of support? Or will this sector recover and begin a new leg up? That will depend on the MACD. Right now, like the major US indices, it is in negative territory. On this slide, I reintroduce the advanced decline line. The AD line is a breadth indicator based on net advances, which is the number of advancing stocks less the number of declining stocks. So for technical traders, we look at this line as it shows us if stocks are advancing or declining. Now here I will use the weekly chart to avoid a lot of the short-term noise. I am using both the 10 and 40-week moving averages to give us a similar result of the daily brethren. As we see, the AD line has been rising, which is good news as this is the same action as the S&P. Now we see some pullbacks along the way, which shows similar action to the S&P. Also, we can see that its short-term peak was around the same time as the S&P and Nasdaq's peak. So for now, the direction of this indicator supports the upswing narrative of the S&P. When both move upwards in unison, that is good. The intermediate term MACD line is also in green. Now we do see some weakening of it, but for now it is still in strength. One reason why technical traders use this indicator is that it will show us if stocks and stock prices are advancing in unison. If we look at mid-2018, we see the AD line going down. This was at the same time the S&P and other indices were going higher to hit their old high. Now that shows no unison, and it is a negative divergence, and shows that not many stocks are supporting the rise in price. And well, we know what happened beginning in October. Now I'll go over another indicator I demonstrated several weeks ago. It is the new high-low line. Now this is considered a leading indicator for technical analysts. Now what is this chart and why is it important? The index tracks the behavior of the stock market leaders by subtracting the number of new lows from the new highs. So what is this telling us? Right now that not all stocks have gotten past their old highs, as was demonstrated by the Dow. In fact, in this recovery rally, several indices, sectors, and stocks have not recovered their old highs. The S&P and Nasdaq have. So what does that tell us? It just shows in a stage 1 rally, there is still more recovery to be made. But for now, it has moved higher, like the S&P price and the advanced decline line. Now again, for the stage 1 to turn into stage 2 long-term bullish run, it will need more stocks breaking from their shackles. The first step at minimum is for this line to break through its 40-week moving average. We are still early in a stage 1 attempt to go into a mature bullish run, so this is normal. The MACD for now is in green, so there is still intermediate term positive momentum. Now again, I want to go over the last major drop we had in 2018. I drew this line to show where the S&P peaked. Notice the MACD never got into positive momentum and the following weeks went negative. And with the AD line showing at the same time a negative divergence signal, that was enough to take the rug under the US stock market. For this slide, I reach back to 2016, when the US stock markets were last in a stage 1 rally. I will use the New York Stock Exchange AD line and the new high-low line to demonstrate what it looked like. So first, let's look at the NYSE AD line in 2016. Again, this was the last time the US stock markets entered a stage 1 rally that eventually graduated to a stage 2 in 2017. Here we see the AD line rising above both its 10 and 40-week moving averages. You do see some dips, which is in line to how the S&P 500 was trending at the time. In fact, we see Brexit and US presidential elections help scare people, but the line never threatened its 40-week moving average. After the drop, it got momentum back again in green, and eventually this led to a stage 2 rally that began in 2017 for the major US indices. Now the chart below shows the new high, new low line. And guess what? Similar to what we are experiencing now, its line was below its 40-week line, even though the AD line was above its long-term moving average. And that is normal, as stocks in 2015, 2016 took a major hit, and like today, many at the time were still trying to get back to their old highs. Now, though slower, it eventually crosses its 40-week line and never even fall below its 10-week line. Even when both Brexit and US presidential elections happened. So the key here is that these two indicators were moving in unison in stage 1 for the S&P. Yes, choppy, but the drop of 2015-2016 was severe, so recovery was needed. Eventually, stage 1 price action and these indicators held their ground despite some uncertain times and eventually graduated to a stage 2. What does this mean? The news of the trade failure was not taken kindly, and markets reacted negatively. But sometimes the news stories are worse than the actual events. I demonstrated how 2016 worked out. There was so much uncertainty that year with England, the European Union, and the US. But after a quick, albeit harsh pullbacks, stage 1 continued. The major technical indicators did not falter, and the US stock markets entered stage 2 in 2017. So for now, what I am saying is that as of now, this is a news event. And we will have more, possibly with Europe and tariffs coming soon. The key will be whether we begin to get breakdowns technically. Will advancing stocks line fall below its 200-day line at the same time the S&P price fall below theirs? That would not be good news. But as of now, we are just in a pullback. In stage 1 this happens, and this stage can be volatile. And I will admit, not all stage 1s turn into stage 2s. But for now, until this part of a possible bull cycle turns negative, we can still be cautiously optimistic. Thank you for viewing my video. Please like and subscribe to my channel for future videos. Also follow me on Twitter at my handle HRSNYC.